Today's guests are Jesse Walden and Jake Chervinsky. Jesse is the founder and managing partner of Varient, while Jake is the firm's chief legal officer. Varient is best known for its early stage investments across the crypto space. And since 2020, it has invested in major projects like Uniswap, Phantom, World, Farcaster, Blackbird, and more. We're excited to have them on to talk about investing, tokens versus equity, the current state of crypto in the US, as well as the SEC and more. Jesse and Jake, welcome on the show.
Thanks for having us.
I was saying before we started recording, I think this is our first double guest that we've had on. So this will be fun. This is like a little arena of people. I'm excited to do it.
Awesome.
To start off, can you two tell us, what does crypto in America mean to you both?
Yeah, sure. I guess I'll take that first. To me, crypto in America means opportunity. And I say that from the perspective of the United States being the best market in both supply and demand in the world. And obviously things have been a little bit rocky in the US for the last couple of years, especially in crypto, but I still think that is true. On the supply side, the United States is still the best place in the entire world for entrepreneurs to build businesses and to innovate in technology. On the demand side, the people that you want to sell products and services to, they're more in the United States than anywhere else. So to me, crypto in America is the opportunity for crypto to truly have an impact on the global financial system. And I think what's really exciting, and I'm sure we'll get into this more, is that we really have that opportunity now, given the new regulatory environment in 2025, an opportunity that frankly we did not have and that was getting killed over the course of the last 4 years and maybe longer than that. So that's my view.
Mine is similar. I'm going to use Jake's word opportunity here and diff it slightly. Economic opportunity. So Jake mentioned the demand side of the market, and this is the best market to sell into. But crypto offers something pretty unique that I think has been core to our thesis at Varient from inception, which is the idea that users can be owners of things on the internet for the very first time. That's they can own their identity, they can own their money, they can own their data. And so not only are users great customers, they can also be investors. They can own assets on online and participate in the economic opportunity of those assets. So, going back to what Jake said, it's the opportunity to build. It's the opportunity for to participate in economic upside for the products and services you use every day. And really excited that there may be finally a path to explore that.
Jesse, just continuing in that vein, we've asked other investors that have come on this show as well, but do you see the current pro-crypto regulatory climate as an opportunity for the so-called American dynamism and for crypto to sort of make a joint comeback or homecoming here in the United States?
Absolutely. I mean, I would just share that in the last 6 months, I would say, I've seen a material change in, our day-to-day, in that we're seeing many more high quality founders getting into the space, including a number of founders in our portfolio, relationships we've had I've been in the space for a decade plus. And, I'm seeing folks who've been in it as long as I have come back for another swing, sometimes after having left the space because of how hard it was to operate in it, over the last 4 or 5 years. And so, yeah, the short answer is yes. I think the pro-crypto regulatory environment is catalyzing more entrepreneurs to jump into the space. And as Jake was saying, like that's to the benefit of the economy at large. So there's definitely an American dynamism aspect to it.
Are you seeing the same with non-American founders too? Are they trying to tap into this market right now?
Yeah, 100%. I mean, there's a number of our portfolio companies that have been operating offshore, and in some cases they are located offshore, and they're coming to the U.S. market for the first time. I think World is a great example of this, where that's a project that has gone to market everywhere else in the world, or many other places in the world except America. And now they recently announced America is their target market, and they're investing a huge amount here.
They also had the token as part of the incentive to get people to kind of scan and get their World ID and everything. And now it's, I believe, opening up in the US as well. So it's kind of like a big shift.
Yeah, it's now available. Like the World app, which is a wallet, is available in the US. It wasn't for a long time, or it was very limited in terms of what you could do. And so I think it's available in 49 states, all but New York, which is probably to do with the bit license, although I'm not 100% sure.
One of the reasons we wanted to have you two on the podcast, aside from, running a very great fund, is that you penned a blog called Tokens versus Equity, which we will dive into throughout this episode. And it's honestly something that we talk about with a lot of guests. But one of the subheads that stood out to me was the quote, "The old SEC handcuffed founders," and the crazed ICO boom that did not outrun the SEC scrutiny. But now, as things maybe shift, that might no longer be a major concern. What do you guys kind of see as truly possible now under this new era with the SEC and other government agencies compared to, I guess, these handcuffs that they existed in the past?
To me, the key opportunity is for founders to explicitly drive value to tokens in a way that the SEC prevented them from doing in the past. And maybe it's worth just doing a little bit of the historical context about how the SEC was handcuffing founders before we get a little bit more into that opportunity. So just zooming back in time to the 2016, 2017 ICO bubble, basically nobody in crypto cared about equity. The way that founders would raise capital was by selling a token on the promise that they were going to use the capital from that sale to build a network. And if they did a good job, they would bring value to the token. And the SEC basically said that is an unlawful, unregistered securities offering. So ICOs really went away due to regulatory pressure. And the industry adopted this two-asset model as a response to that regulatory pressure, where instead of selling a token to the public, instead, a company would do a private placement of equity, which is compliant with Regulation D under the securities laws, selling equity to venture capital firms or other private investors, along with some right to tokens in the future, often in the form of a token warrant. And then they would use the capital they raised in this compliant sale of equity to build whatever decentralized network they were going to build. And then once they achieved this concept of sufficient decentralization, which we spent many years trying to understand and frankly never really did, once they felt like they had met that test, they would then launch a token. The problem is the SEC then said, through many different types of guidance in enforcement actions and complaints filed in federal court, through a framework that they issued in 2019, that in order to avoid the token being classified as a security, the founders then had to essentially abandon the project. They were not allowed to continue to carry out any ongoing efforts to bring value to the token. And the SEC was so restrictive, they even said things like, the company retaining tokens on its balance sheet is an indicator of security status, because the company then might have some financial motive to carry out some efforts to bring value to the token. So what this led to was a market in which, for about 4 years during the Gensler regime over at the SEC, founders launching tokens and then explicitly walking away from them and trying to drive value to their equity rather than to the token. And that has resulted in this market where, unfortunately, these projects couldn't remain competitive in the marketplace, right? It's not really possible for a tech company to launch a product and then never iterate on it, walk away from it completely, and then hope that it's still going to compete in the marketplace. It also led to this phenomenon of decentralization theater that we've all talked about a lot, where in order for any changes to be made to a protocol, those changes were supposed to be made by decentralized governance, an unaffiliated, dispersed group of token holders who are sufficiently decentralized under this test that the SEC had explained. The problem is that decentralized governance is extraordinarily inefficient, right? Almost by design. The point is that it is very slow and very costly in order to make any changes. And again, what this meant was it was really hard for companies or for any of these ecosystems to iterate in a way that kept them competitive. So I'll stop there and let Jesse maybe to pick it up, or you guys follow up on this. But the solution now is, especially given the new opportunity with the new perspective from this SEC under Chair Atkins and Commissioner Peirce running the crypto task force, that founders can carry out efforts to bring value to tokens without them being classified as securities.
Yeah. So Jake, I want to follow up on that point. It's a really interesting argument. And I came from kind of the traditional venture side of things too. And I remember the first time somebody explained FDV to me, I was like, as a concept of raising a funding round, I was like, okay, so you just kind of magically double up, 40 million safe cap is 80 million, FDV. There's a lot of weird, I think, concepts sort of baked into the math, the way things were being done under sort of the previous SEC regime. And I'm aligned with a lot of the points you guys made. One of the other weird ones to me was the idea of labs and foundation being the governance organization for a protocol. Labs would kind of raise this round and then immediately kind of violate their own fiduciary duty to the investors by trying to drive value to the token, right? Nobody, we'll see in this future M&A environment if there's more picked up on kind of the labs side of things, whether these devcos actually have real value beyond the token. I think that's kind of to be seen. But you made a really interesting point that I want to press on a little bit in that article, which is that the powers exist outside of the boundaries of any legal entity, including the company that created the infrastructure. The company can fail, but the powers conveyed by the token will persist. I agree with that. In theory, do you think there are many projects that have actually achieved that level of independence? Like, I can't think of a ton of examples of where the labs could literally shut down and we've achieved that kind of decentralization and that power structure that you're talking about.
It's a great question. And the first thing I would say is the point isn't that the company can't affect the value of the token or can't affect the token holders, right? The point is that the token holders, especially when they acquire the token, understand exactly what it is that they are acquiring and that what they are acquiring does not depend on the company. This is crucial to differentiate a token from a security. A traditional security lives and dies with the company, right? A stock depends on the company existing. If the company stops existing, the stock stops existing. The same thing with every other type of security, right? A bond is a liability of a company to make payments, right? Interest payments and to return principal. If the company goes out of business, the security is essentially worthless. A token does not need to be that way. Now, obviously, you can design a token that is that way, but the reason we wrote this paper is to encourage founders who are designing new tokens or trying to figure out how to upgrade existing infrastructure to follow a model where token holders know exactly what it is that they are getting. And what they are getting is not control of the company. What they're getting is control over on-chain infrastructure. And this is, like Jesse said, the unique innovation of a public blockchain and of a digital asset that lives on a blockchain is the ability of the holder of the token to own in a self-sovereign way without reliance or dependence on any third party, some specific digital property, often smart contracts or transaction flows, revenue, something that is moving on chain that again does not require the company to be in business, where indeed the company can go out of business and all of what the token holder owns and controls stays in effect and remains. I think there are a handful of good examples of this. I think Uniswap is one really phenomenal example. Maybe I'll turn it over to Jesse, who might want to add a couple words on that.
Yeah, I mean, so I'll just run with Uniswap as an example, right? There's, it's one of the largest decentralized exchanges, and the infrastructure that's owned is the actual DEX as well as the governance apparatus. Uniswap also, the labs company today, operates a front end interface, and that front end interface generates a lot of fees. What's interesting about those fees is they are entirely on chain, so anyone can look up at any given moment what labs is earning from their interface fees. There's no information asymmetry there, which is one of the key things securities laws are designed to protect against. And so there's some world you can imagine where those interface fees maybe could flow to token holders because token holders are could be in control of all the on-chain infrastructure, including how interface fees are routed to the protocol or to token holders. And they could be one of N, interface providers that does that. So that I think is a good example. To your question, Gerald, about decentralization, and are there a lot of projects that could exist without the lab scope? I mean, Uniswap is also a good example there, where today I think something like it's something around 40% of the volume flowing through the protocol, maybe even less, maybe 20 to 40%. Goes through the Uniswap Labs front end interface, and the vast majority goes through third party interfaces. And so that's one example. I would say they are definitely, in my view, sufficiently decentralized. And the new opportunity is like more of the value that's being created throughout the stack, from the low level protocol all the way up to the product, could potentially go to token holders through again, hypothetically, through the argument we're laying out, because the infrastructure is entirely on chain and can be controlled by token holders.
Bitcoin might sound complicated, but the Gemini credit card makes it simple. Use it like any credit card. Buy lunch, gas, or your weekly groceries, and you'll earn up to 4% back instantly in Bitcoin or one of over 50 other cryptos straight to your account. No annual fee, and right now you can grab a $200 Bitcoin intro bonus. It's the easiest way to start building your Bitcoin stash. Go to gemini.com/CIA to learn more. Terms apply.
I think it's a really interesting argument. I know there are definitely some sort of, maybe like Maker is an interesting one, right? Where they're surviving kind of without a labs co. Do you think though, if Uniswap Labs shut its doors tomorrow, that I understand that the point about the on-chain volume, but everything else, that these companies do, you think it would continue to operate without Uniswap Labs?
So the key distinction in my view is the protocol itself and the on-chain infrastructure would continue to operate. There's a separate question, which is, would it continue to be competitive?
Fair.
And as Jake was saying earlier, I think when a team has to stop working on a project, it's hard for the project to remain competitive. And so that's like a known risk, right? And as Jake was saying, it's really important that token holders know what they own and what they don't, right?
I agree with that. And again, I would say the key question is not, would there be some impact on the value of the token if the development company were to go out of business? Because since we're talking about this in the context of the securities laws, the securities laws are not meant to apply to every commercial engagement where one business's financial situation can be affected by another business, right? And we give an example in the paper that might be worth unpacking a little bit here, which is the example of a property owner who acts as a landlord, but then hires a property manager to manage their property. Now, the landlord is the ultimate owner and controller of that property, right? They're the ones who are going to profit, but maybe they don't want to do all of the work on the property, right? They're not going to do all the construction. They're not necessarily going to go find the tenants and handle the rents and all that good stuff. They're going to hire a property manager to do that. Now, if that property manager does a terrible job or goes bankrupt, well, that's going to be pretty bad for the landlord, right? The property might lose value. The landlord certainly will lose some revenue they would have gotten. We do not apply the securities laws to that type of commercial relationship. And the reason we don't do that is because there isn't an information or power asymmetry between the landlord and the property manager, right? The landlord is ultimately the one in control of their property. They're making a business decision who it is that they want to hire, but what they own persists regardless of what happens to the property manager. They can replace the property manager. They can decide to stop renting the property. And because there isn't that asymmetry where they are hopelessly dependent on the manager for their ownership, for the value of the asset that they own, we decide basically we don't want to apply the securities laws. We have all kinds of other laws that apply to address whatever may go on between those two parties. And that's the nature of the argument in the paper, is that there are ways to address the risks that are otherwise uniquely addressed by the securities laws through these other types of models that make sure the token holders are the ultimate owners and controllers of on-chain infrastructure.
Jake, I'm curious whether you expect ICOs, which were taboo for quite some years following 2017, to make a comeback under this new regulatory regime. I know you guys mentioned the safe harbors quite a bit in the paper. Is that something you see coming back under a safe harbor, or maybe something incorporated into market structure? How do you envision that?
So in the medium to long term, I definitely think that ICOs will come back in a regulated and compliant way. Whether that happens through a safe harbor that the SEC adopts in rulemaking, or whether we get that in market structure legislation, or both, frankly, one after the other, I think is an open question. But it is a feature of every market structure legislative effort, including the Clarity Act, which is moving forward in Congress now. And the SEC has said that they are working on a safe harbor. I think the sort of interesting question is, do we see ICOs come back before then? Because a lot of people have treated this new regulatory environment as essentially there are no laws anymore and we can just do whatever we want and we'll get away with it. And I think, candidly, we might see some of that, but I don't think that that's going to take over the market. The SEC, I think, has been very clear that they are no longer engaged in a campaign of regulation by enforcement against the industry. That said, the law still exists and we still need to follow it, right? We saw this very clearly in a recent statement from Commissioner Peirce about on-chain securities, about the tokenization of securities, where she basically says, look, this is really exciting, but it's not magic. You can't just put everything on chain and the law doesn't apply anymore. So I think ultimately long-term ICOs will come back, but I don't think that's going to be a feature of the market until we get some regulatory clarity. And I don't expect that to happen in 2025. So that's more likely going to happen next year or later.
Do you think we'll get safe harbors this year? Is that something you mentioned the SEC was working on it? Do you expect that to come sooner rather than later?
Well, sooner than later, I would say yes, and maybe sooner than we get market structure legislation, which is a whole other can of worms. But, this is a really hard challenge. And I think many people have been very unfair to the crypto task force for, seemingly not moving fast enough. My view is the exact opposite. I think that Commissioner Peirce and her team have done an extraordinary amount of work in a very short period of time. And when we talk about something like a token safe harbor, which, for context for the audience, would set out reasonable rules by which a token issuer can sell a token to the public, to retail investors, to make certain appropriate disclosures about the project, to impose reasonable resale restrictions on some of those purchasers, or maybe just on insiders like investors or company employees, and then have some period of time, maybe 3 years, maybe longer, to meet some decentralization test. And then if they satisfactorily meet that test, then the token will be treated as a non-security or as an exempt security. When you talk about the details of getting something like that right, it's going to take a long time. And in order to get it into law, it's not something the SEC can just announce someday. They're going to have to go through the notice and comment rulemaking process under the Administrative Procedures Act. That's going to take a long time, right? That means we get a notice of public rulemaking, we get comments, maybe we get an update, then we get a final rule, then maybe there's some period of time before the final rule actually becomes effective. That just is a years-long process. So I would expect it to be next year at the earliest. And that would be if the SEC is moving pretty fast.
On the safe harbor front, Jesse, I'm curious, following Jake's comments, what kind of opportunities would this open up or tap into for the founders within all of your portcos that don't already exist?
That's a great question. I think the principal thing that I'm most excited about in the safe harbor is the idea that founders will be able to kind of build full stack again. And meaning, as I said earlier, build from the protocol all the way up to the end user products. And if you look at like the most successful projects in crypto, and I'll, we've already talked about Uniswap, about Morpho is another portfolio company in the lending space that's very successful. They've all done exactly this. They've built both the protocol and the product. But as Jake was saying, under the past administration, many of them had to stop work on the protocol once they launch a token. And so on a go-forward basis, under this safe harbor, the expectation is teams will be able to continue to build full stack all the way from the protocol to the product. And, that is, it just opens up so much opportunity because founders have all the levers to pull to figure out how to make the project successful, as opposed to just half of them. And so, that to me is the exciting thing. It's like the best talent can actually go and execute with the gloves off. And I think we'll see a lot more projects be successful as a result of that.
Yeah, I think lending is a really interesting use case, and I guess use case is the wrong term. It's a really good implementation of the technology. We're seeing, I guess, a lot of momentum around the tokenization, RWA, kind of the real asset space. Commissioner Peirce just put out very recently this, I'm just going to call it the security swap memo on tokenization, where she essentially, I think, was reminding folks that if you gave a right to a beneficial owner that did not actually confer an interest in the security itself, that it was still a security, it was a swap. And so the for viewers, basically the underlying context there was we've seen two big products launched in the last few weeks, and I think we'll probably see a lot more. One was the Robinhood kind of OpenAI stock token thing, and the other being like the Republic. I think it's actually structured as a debt instrument, but based on SpaceX stock. Do you guys think is that type of technology interesting as investors, right? So, and maybe Jesse would love to know your interest in that type of product versus pure kind of on-chain finance, DeFi and lending. Like, do you think those products are interesting to you guys? And then Jake, like, what do you think of kind of the legal structures that we're using to put some of these things together?
So on the commercial side, I would say in short, yes, I think it's interesting. I think, coming back to the kind of core thesis at Variant, making users owners, right? It's not limited to, crypto protocols. I think there's a world in which, traditional companies may want to do the same thing. And you see this in public markets where there's companies like Tesla and Palantir and others that have like very fervent kind of communities of investors, retail investors, who arguably like contribute to the growth of the company. So I do think there's a market there for on-chain securities, and the kind of downstream effects of securities coming on-chain are, I think, going to be a tailwind or a tide to raise all boats in DeFi, right? So once you have more assets tokenized, you'll have more exchange for decentralized exchanges. You'll have more lending for lending protocols. And I'm sure there'll be a lot more kind of middleware infrastructure opportunities to invest in. So we're definitely interested in all of that. One thing I would share though is, and I'm sure Jake will get into this, I think for equities that are already publicly listed and tradable in the US, the opportunity may be outside the US. People who don't have access to invest are probably the customer to serve there. And here in the US, I think the opportunity may be more so, assets that don't already have a market. And both examples you gave, Robinhood and Republic, are private equity. And I do think there's challenges there because very often, these companies have very strong, restrictive covenants about how, their equity can trade. And so I don't know if that ends up working because of that. What I'm most excited about on the secured, tokenizing securities side is, companies that actually want to go and make their users owners, having a path to doing it, right? So not some third party surreptitiously trying to tokenize private stock, but rather net new companies, maybe crypto native companies, tokenizing their stock as a security and allowing their users to own it. So for example, this is pure conjecture, but I could imagine, Phantom is a portfolio company that's doing really well. Years out from now, when they're ready to go public, you can imagine a world, if we have the clarity from the SEC, where that happens on chain and you're able to trade Phantom stock in the Phantom wallet, right? And that's the type of thing that I'm most excited about.
Well, I totally agree with all of that. And I am also very excited about the world of on-chain securities. And I use that term very explicitly, on-chain securities, not tokenized off-chain securities and not tokenized security-based swaps. And I do think those are sort of the three different ways that this market could come on-chain, right? The first is you just have a token, which is a wrapper for some off-chain security being held in the traditional securities market infrastructure. The second is you have a token which just gives economic exposure to the off-chain security. It doesn't even carry the rights of the security itself. The third and by far most exciting to me version of this is the on-chain security. The token is the security. We have upgraded the entire securities market infrastructure to be on-chain. And I think to me, that's where the real promise of applying DeFi to securities markets comes into play. And that's where we've been sort of blocked for the entire history of crypto. The securities laws, as they are implemented now, mandate intermediation in a way that prohibits securities from trading in a decentralized environment. That's the entire reason we've had this whole binary where if tokens are securities, they're totally dead in the water. And if they're non-security commodities, then they're totally fine. And what we want to do is upgrade the entire securities market to take advantage of that decentralized environment. Now, that is a really big challenge because it's not just a crypto issue, right? It's a whole securities market issue. And when we talk about things like the token safe harbor or market structure legislation, none of that even touches on-chain securities. All of that is about defining regulation for these tokens that we view as being non-securities because of some measure of decentralization or remoteness from a securities-like relationship that justifies applying the traditional securities laws. What this means is, from a practical perspective, to get from today to a future world where we are trading securities on chain will require not only rewriting the securities laws, so it will require the SEC to do some work, either providing exemptive relief or writing new rules for the securities markets. It will also require us engaging with all those traditional securities market folks who are not a fan of any of this because it really is very disruptive to their business. So, the SEC has been thinking about this a huge amount. We've seen one leading project called Project Open, which is led by my friend Miller Whitehouse Levine over at the Solana Policy Institute. It includes some other folks, including Phantom, sending letters into the SEC. There's already pushback from SIFMA, which is the traditional securities market group, sort of front running this, basically saying, do not give exemptive relief to these crypto people. They're all criminals. Don't buy what they're selling. And so I think this is going to be a really big and difficult fight for the crypto industry, but it's one that to me is absolutely obvious. To me, there is no question that securities are more useful and better on chain than they are off chain. They are frankly not that different in a sense from stable coins. A dollar is just better on chain than it is off chain. And so I think we will get there, but it's going to be a really heavy lift where the regulation is going to be really slow to catch up to the technology.
Yeah, Jake, in the paper, you mentioned the difference between having equity and then the token, right? So I'm curious how you would characterize the real relationship between tokens and equity in crypto compared to the traditional markets. And then also, I think because there's been it's been such a battle, right, for the crypto industry to try and figure out, what is the SEC thinking when it comes to securities? Like, what is a security? What is a commodity? When we think about tokens, like, how would you distinguish tokens from securities?
Yeah, I do think the key question is, what are the rights or powers that the holder of the instrument has? So the holder of a security has rights to a company, right? If they have a stock, they have certain economic rights, governance rights, other rights to vote on certain issues specific to that company. Token holders don't have rights, they have powers. And I think this is a really important distinction. A right is something that you can go to a court of law and enforce against some other party. It requires deference to a legal system in order to enforce that right. But it on its own doesn't give you really any power whatsoever. A power that a token holder has is not enforced in court. It's enforced in code. If you have powers over on-chain infrastructure, you are not dependent on any third party in order to exercise those powers. So to me, the key distinction between an equity and a token is that equities give people rights enforced off-chain that are specific to a company. Tokens give holders powers that do not require dependence on any trusted third party, that are instantiated in code and don't depend on the creator of that token. And then when we think about how to sort of characterize these things, I do think that's what we're working out in the safe harbor and in market structure legislation. I think that this distinction I've laid out is my best view on the policy and the principles that underlie and motivate the securities laws. Obviously, not everybody agrees with me, right? Gary Gensler did not agree with me. Tim Masad, who is a Harvard professor who was testifying in Congress recently, certainly doesn't agree with me. There are a lot of people who take a different view, but I think that the regulation will catch up to this perspective that equities are fundamentally different from tokens. And also, as Jesse was saying, that doesn't mean that equities are bad. Sometimes a founder just wants to sell equity in their company, and they should be allowed to do that with absolute clarity, and that equity should also benefit from existing in a blockchain-based environment. And I think we'll get there too, but also will take quite a long time to get there.
I'm curious, as tokens start to get more regulatory clarity, what would it look like for token holders in terms of these powers that they have compared to, ones that shareholders have with traditional equities? Do you see it shifting or changing at all, or it would just stay the same now? It just has like a legal framework around it.
One thing I would jump in with here is, I think in the past, Jake touched on this earlier, there's been a lot of reliance on decentralized governance. for purposes of portraying sufficient decentralization. And that has been ineffective because a startup cannot move at the pace that a slow governance committee moves at, right? Like you need to move fast. So I think one of the principal benefits of getting this safe harbor regulation done is that you will see stronger forms of delegation possible in decentralized governance. So token holders will still have the power of governance over the on-chain infrastructure, but they will be able to delegate more day-to-day decision-making to third parties, delegates, including potentially, the company, the service company that like built the protocol originally to continue, tweaking parameters, maintaining it and so on. And I think there's been a huge reticence for a lot of projects who've launched tokens, for the founding team or to continue to contribute or to participate in governance in any way, to be a delegate. So I think that's one of the principal changes, and probably the most material one, in that it will allow the people who are most expert in these protocols to continue to contribute and sort of have day-to-day impact on them.
So I completely agree with that. And I think that is going to be a meaningful difference from the world of decentralized governance that we've had before. And I'll go back to the example that we used in the paper of a property owner with a property manager. And I really do think that token holders are going to look a lot more like the owners of real property than anything else, right? They own on-chain infrastructure. They may hire some people or compensate some people to do some work there. They will benefit from cash flows related to that property that they own. And in many cases, they'll have very little participation whatsoever, right? You can think of a lot of landlords, or even in the extreme case, someone who owns a very large plot of land and then signs a 100-year lease for someone to, exploit the natural resources on the land, right? Like someone who has an oil company that has leased the land for 100 years. They literally do nothing. They just sit there and collect checks month after month, year after year. And I think you could imagine token holders being much like that. What they will not do is what a traditional shareholder in a company does, where, they're managing a board of directors and a set of officers of a company. They're voting on issues of, fundamental corporate governance. They have certain rights that are granted to them exclusively by whatever state or jurisdiction where the company is incorporated. I think that token holders will look very different from that. The one other thing I will throw in, though, when you mentioned the question of the legal rights or the legal structure around the token holders, is that I think we will start to see token holders increasingly adopting new types of legal structures that are designed specifically for this type of token holder ownership and governance delegation. And the best example of that right now is the DUNA in the state of Wyoming, the Decentralized Unincorporated Nonprofit Association. And I won't bore everyone with the details. I know also Miles was already on the show, and Miles has done a huge amount of work, and great credit to him for pushing the DUNA forward. But this is essentially a legal structure that gives DAOs the benefit of limited liability, extraordinarily important, and also gives them legal personhood so that they can do things like pay taxes and hire contractors and carry out their will in connection with the legal system without being totally subject to it like a traditional LLC. So I think that we will see a lot more tokens taking advantage of the DUNA and also other similar structures that I think we'll start to see come online in, the next handful of years as other jurisdictions see this opportunity and decide to take advantage of it.
I don't know if you all have noticed this recently, but Avalanche has been on a roll. From FIFA launching their own Layer 1 on Avalanche to VanEck unveiling the purpose-built fund to back ecosystem projects, the world is watching and building on Avalanche. Web3 gaming? Avalanche-based titles like MapleStory and Off the Grid have it covered. Finance? Avalanche has got that down pat too. Entertainment? Built for that as well. On top of that, starting in 2026, Sports Illustrated Stadium will be the first major sports venue to fully adopt blockchain ticketing powered by Avalanche. Backed by a strong network of builders and dedicated community, the momentum is accelerating on Avalanche for games, music, sports, finance, and more. Want to see how Avalanche is driving adoption? Go to avax.network and check it out.
Jesse, I have to ask, you went to, I guess, like the founder factory of Canada, McGill, right? You have like a media background. and you've been in the crypto space for a long time. Just being on the investor side, did you ever think that you would be this inundated, this much of like a policy and securities law expert? Like, what has that experience been like? Obviously, you have one of the best minds in the space, at your side, but like, what has that journey been like?
Well, yeah, very grateful to have Jake by my side, because I had absolutely no plan of getting this deep in the weeds on like legal, regulatory, and policy stuff when I got into crypto. My background, as you said, like I came into crypto kind of through a side door that not many people saw, which was through kind of a media background. I was in the music industry and working with artists. And when I learned about Bitcoin, what I saw in the protocol was this opportunity for anyone to own a piece of data that they signed with their private key and put on the network. One of the things they can own, of course, was a Bitcoin, which is this new financial asset. I wasn't so much interested in that initially. I was interested in what other types of digital assets you might be able to own, like images, videos, songs. And I started a company called MediaChain to pursue that. It was, vaguely in what became the space that became known as NFTs later on. Still think that is a very important idea that hasn't quite been realized. And this was 2014. At that time, there wasn't a lot of people thinking about alternative use cases of blockchains outside of Bitcoin. And so the focus very much was on Bitcoin and how to treat it as a new type of asset. And there was already some legal, conversations and compliance conversations around that, but very little about protocols and new types of applications you could build on top. And so it just came with the territory as we got further and further down that path, and ended up with a pretty hostile, administration here in the US. You had to learn about it. You had to go deep. And that's, I would say that's one of my favorite things about crypto is it is so multidisciplinary, that someone from the music industry and someone from finance and someone from policy world, like all have, a dog in the fight, so to speak, and all have perspective that's valuable for the industry.
I think something that keeps coming to top of mind is something that Jake put out on X. I think it was a few months ago. It was a thread about the top policy priorities to make the US the crypto capital of the world, which included stablecoin legislation, market structure legislation, security safe harbor for token issuance, which we've talked about, protections for banking access, and protections for non-custodial software developers. Don't worry, I definitely wrote this down. It's not coming off the top of my head. But I think we've discussed most of these topics on our podcast with other guests that we've had on. We've had the SEC Commissioner Hester Peirce, Caitlin Long, Tornado Cash's Roman Storm, and a number of industry players who are like tapped into these categories as well. Question I have for you, Jake and Jesse, is, fast forward from when you wrote this, Jake, in March to now, which of those 5 categories do you think has lagged the most by priority, and which one do you think is the most pressing? I think I could figure out the most pressing, but it's for you two to answer.
Well, I'll jump in first, and my answer on both is the same, which is protections for non-custodial software developers. I think it's both the most important because it is an existential issue, right? If developers cannot build non-custodial software, then they cannot build crypto in the United States, full stop. And I think that this issue has lagged the most because Roman Storm is going to trial very soon. And I really appreciate you guys having him on to tell his story. And it really has been extremely disappointing to see that even despite the extraordinary shift in policy from the Trump administration, that the Department of Justice is still moving forward with this prosecution. And what we saw—
Can I jump in there? I wanted to ask you why you think that the DOJ is still going forward with this case, even though it seems to go against everything the Trump administration has been advocating for, has been pushing for since he got into office.
It's an excellent question. I honestly wish that I could explain it to you, and I do not have a good explanation other than to say that I think, generally speaking, DeFi is the greatest challenge to government, period. And regardless of the government, right, regardless of the regulators at the Treasury Department or the folks in law enforcement or handling national security, they are all very concerned about losing the control that they've had over the financial system thanks to the Bank Secrecy Act over the last 50 years. And I think also they get scared by headlines that suggest that, for example, North Korea is funding its missile program thanks to crypto, which is not true. But what it makes them feel is the only way for them to get a handle on this new, very disruptive, very challenging technology is to just stop it in its tracks. And I think that what's been really disappointing, very much to your point, is that we did get new guidance from the Department of Justice, which was a step back from where the Biden administration was. So the Deputy Attorney General, Todd Blanche, put out a memo saying the DOJ is not a digital assets regulator. We are not going to engage in regulation by criminal enforcement against DeFi developers. And in response to that, the prosecutors in the Storm case dropped actually not even half of one of the counts against Roman Storm, but they continue to fundamentally misinterpret the definition of money transmission to say that the developer of a non-custodial protocol who has absolutely no control whatsoever over user funds is still somehow transferring funds on behalf of the public under Section 1960. And until the government takes a different point of view, or until Congress solves this problem, we're going to live under the threat of this existential issue for crypto in America.
Yeah, I want to talk more about obviously the Roman Storm case. We'll be watching closely, and we hope that that comes to the right conclusion. You mentioned this other sort of existential threat, which is DeFi, right? And so I know before we hit record for the show, you were talking about very specifically kind of the 409 out of Clarity and the way the legislation is progressing as it pertains to DeFi. How do you think we're doing, I guess, on Clarity? Is this a passable piece of legislation in your view? And if not, what do you want to see in a bill that actually adequately supports DeFi in the United States?
Yeah, so I'll jump in for starters, and I'll say, in general, I'm a big fan of the basis of Clarity, sort of the core foundation of the bill. We've spent many, many years. I've read, dozens of market structure legislation drafts over the years at this point, and frankly, I've never seen a framework in general that I think has been nearly as good as Clarity. So I think that the authors of the bill really got a lot of the key pieces right. You mentioned, though, how the bill treats DeFi. And I'll say that for the many months that we've been working on Clarity, the bill did a really great job of correctly applying regulation only to the trading of decentralized assets on centralized platforms. And that was always the goal, right? Not to regulate DeFi before we even really understand what the DeFi market is going to look like. And so the bill had carve-outs, protections for DeFi developers in both the securities and also the commodity derivatives sections of the bill, sections 309 for securities and section 409 for commodities. I will say at this moment, as we're discussing this, we saw some changes from the rules print, so the reconciliation of the Clarity Act as it came out of the House Financial Services and House Agriculture committees, that seems to walk back a lot of those protections for DeFi developers building derivatives protocols in a way that suggests that the CFTC might be able to regulate a DeFi developer purely for writing code, even though they are not engaged in the operation of an entity that is subject to registration under the Commodity Exchange Act. And how these things happen is sort of a complicated question behind closed doors, and we never really know exactly what's going on. But I think this is a red line for much of the industry. DeFi is what brought many of us here in the first place. We believe, or at least I'll speak for myself, I believe that DeFi is the promise of a public blockchain. We want to decentralize and disintermediate the financial system. And I don't know that the DeFi world is going to be willing to compromise on that essential issue. So I think that we're going to have a lot of trouble if we're trying to pass market structure legislation that throws DeFi under the bus just to create a regulatory mode for some of the centralized platforms. I believe that policymakers deeply understand this, and it's a political challenge that hopefully we will be able to overcome in the House, and if not in the House, or even so, once the bill moves over to the Senate and we start working on market structure with the Senate Banking and Senate Agriculture committees. But that's where it stands right now.
They also have their own market structure version coming out. So it'll be interesting to see how they square that with the House and how different they're actually going to be. It'll be an interesting thing to watch. I'm curious also, we're probably soon going to see a vote out of committee for Brian Quintenz, who is the Trump's nominee for the CFTC chair. He's obviously a former commissioner. He's very familiar with crypto from being at A16Z and also with the CFTC as a whole from his days as a commissioner. I'm curious, are you hopeful that he may bring maybe some more clarity, some more, I guess, sense to the whole market structure process, just coming from where he's come from, knowing who he knows, and just kind of the job he's done in the last couple of years? Is that maybe a bright spot for you guys in DeFi?
So personally, I absolutely think it is. I know Brian pretty well. I've had the pleasure of working with him over the years. I think that he is a brilliant person, a very experienced regulator. I think he really understands the appropriate role of regulation in crypto, and he knows the technology really well. So, he's also very well liked, and so I don't think he'll have much trouble getting confirmed. And I think there is a huge role for the CFTC going forward. I think even if we don't get market structure legislation done, there's at least 4 different categories of rulemaking that the CFTC ought to do pretty soon. One is on prediction markets, and that maybe Jesse wants to say a little more about that, but really exciting category for us at Variant and in general. Rulemaking on DeFi, rulemaking on perpetuals contracts, also as an invention of crypto that has become extraordinarily popular, and also on 24/7 trading, something that crypto also, I wouldn't say uniquely, but is particularly effective at enabling. And then if we do get market structure legislation done, well, that's going to be years of rulemaking to figure out what all the details are in implementation. And honestly, I can't think of a better person to lead that effort than Brian Quintenz.
Yeah, Jesse, do you want to follow up on the prediction markets side of things? Because I feel like that is, aside from crypto, prediction markets going to be sort of the second place biggest thing the CFTC is probably going to deal with this year in terms of like new technologies coming along and how to regulate it.
Yeah,
is that something you guys are watching at Variant?
Yeah.
Absolutely. Yeah, go ahead, Jared.
I was just going to say, I'm curious in general. It seems like from some of the folks I've talked to that like perps is almost like a done deal. So I don't know how you're working with like founders and teams on some of these kind of like foregone conclusions on the regulatory side, but it seems like you guys are obviously working with some enthusiastic builders there.
Yeah. So on prediction markets, what I would say is, we're very excited about the category. I think kind of a good analogy for why to be excited is I think prediction markets tend to be very similar to social media in that, social media is this kind of like umbrella category. There's not one winner or two winners, there's many winners. And social media networks are differentiated by interest graph, by demographic, popular media type, and so on. And so I think it stands to reason that prediction markets similarly can be differentiated along these axes, different types of media, different types of interest, different social graphs. And so I think there's a lot of greenfield opportunity there. And much like social media, changed our relationship with how we consume information, I think prediction markets are doing the same and will continue to do the same. And we'll look back like 10 years from now, and people will, think it's weird that we didn't have markets to figure out what was close to the truth and what was not. So, so very excited, and we've made some investments there, and we'll continue to make more because I think there's a lot of opportunity that's not directly competitive. And Jake can probably speak more to the perps, whether perps are a foregone conclusion and what it means for teams.
Yeah, sure. And it's funny the way you put that, Gerald, that, perps are a foregone conclusion. And I think like in a way that's true, and in a very explicit way in that people are launching perps products. And, this partly has to do with the fact that the CFTC has a self-certification regime. So if you are a DCM or you're a regulated entity and you feel comfortable launching a product, you just sort of tell them you're going to launch it and you hope that they're not going to come after you. And hopefully you've had conversations with them to be pretty confident about that. But the CFTC has never actually done any rulemaking or issued real guidance about perpetuals. And I think they will do that because it is a unique product, quite different from, what we've seen before. And you better believe that under Russ Benham in the last administration, there was no way people were launching perps without, having some clarity on the record about it. But I do think it's very likely that the CFTC will take this up. It's a great example of one of these types of products that was not allowed in the US as a result of regulation, nonetheless arose in offshore markets, proved itself to be both extremely in demand and also extremely effective. We didn't really see any blowups or problems with
Jake,
perps. And this sends...
No, you're good. Could you just explain for our audience what perpetuals are, just for those who might not know what it is?
Yeah, so I'll put this in the most lay terms I can, because I can't do any other than that. But essentially, a perpetuals contract is a derivatives contract that exposes the owner to the price of a particular asset. It does not expire, unlike other types of derivatives like options or futures, and it tracks the price of the underlying asset very closely using a funding rate that sort of balances the market between longs and shorts. Maybe Jesse, I don't know if I got that right.
Nailed it, in my view, yeah.
And like, this is very new and unique, right? To have a derivative that so closely tracks the price of an underlying asset that doesn't require rolling over, and that is somewhat sort of self-maintaining in a way that other assets aren't. So like BitMEX launched perpetuals and it worked really well. And then everyone else launched them. And now you have Hyperliquid, which is a massive perpetuals exchange. And I think we're going to start seeing this come into the US as time goes on, for sure.
The only thing I'd add, Jake, is like a very simple way to think about perpetuals as a product is it's a way to go levered long or levered short any asset starting with crypto without having to reason about like complex options structures where you have a strike price and an exercise date and so on. It just really simplifies the process of going long and short with leverage.
It's like the pass line on a craps table or something. Like it's just
right. That's why they're so popular.
Yeah,
they're simple, they're accessible to retail, and they allow you to express a view with high upside.
Yeah. So we talked a bit earlier about this, the structured sort of traditional, crypto exposure assets into public traditional markets. And Jake, I'm curious, there was some guidance that was recently published by friend of the show, Greg from Multicoin, directing or advising the SEC to take a look at the way ETF listings work. And so traditionally, it's been a 19b4 listing path, and they're proposing sort of some general GLS and some general standards on how that may work. That's obviously not implemented or finalized yet, but there's basically a substantial float test, and then there's like some listings of options replacing kind of this 19b4 process. You mentioned sort of the speed of the task force. I totally agree with you that, Commissioner Peirce and her team have done a lot in a very short amount of time. Do you think that's going to impact, because there seemed to be a real rush into the public markets to get these ETPs, ETFs launched, to get that traditional market exposure to crypto assets. Do you see that rule, if it is finalized in somewhat of its current form, affecting the way people get these products to market, or how do you see that developing?
Yeah. Well, I'm first a shout out to our friend Greg, who's both a phenomenal lawyer, also one of my fellow board members of the Blockchain Association. I think he did amazing work on that, as he always does. I don't have a strong view on sort of what the next steps are. I think you make a great point that the crypto task force has done a huge amount, but one of the first things they asked the industry for was guidance, not so much guidance, but our opinion on what the priorities are. And Commissioner Peirce put out this great piece with 48 or so different questions about various areas that the SEC could tackle. And the list of things they could do is just extraordinarily long. And they are human beings, so I think it's uncertain what they'll be able to get to and on what cadence. But I also think that people are very creative about getting these products out into the market. One example of that in this context is the Treasury Company, right? So, it's like SharpLink is one example, MetaPlanet is another, MicroStrategy is the, sort of beginning of this, which is a publicly traded company that acts almost like an ETP, an exchange traded product, or an ETF, without having to go through that whole process. And we're seeing that happen more and more just because of the flexibility that approach gives folks. I think, open question how that will end and whether that will persist, or, whether there's some hidden risk there. But I do think that where there is demand, and there clearly is significant demand in the public markets for exposure to these assets, you're going to find all kinds of different ways for those products to reach the market.
It's funny you say open question, because that was definitely a question we all had. If you could see us like kind of smirking, it's because everyone keeps bringing up these like Bitcoin treasury strategies or insert asset treasury strategies. And I'm kind of the camp that it's oversaturated and there's too many. But I'm curious if you two feel similarly. I think, Michael Saylor was one of the first to do it. And it's not always being first means you're the best. Like we've seen how we had MySpace and then other social media apps took over. And that's a different analogy. But you get my point, is like we had strategy and now there's other ones. And so maybe those ones will succeed further. But I'm curious both of your takes on this, because every time someone brings this up, we're always like, we just don't have the time, but we're going to give you guys the time to give your feedback on this.
I guess first thing I should say is like, it's not something I pay a ton of attention to because I don't find it to be all that innovative, right? The innovation is entrepreneurs who are going and building the protocols.
Well, yeah.
It's a math.
Right,
it's a math
exactly.
problem.
The things that get me excited are like, new things that entrepreneurs build that result in these digital assets that these companies then want to go and make it, package up and sell to the public markets. And so, yeah, there's too many of them in my view, because like, what I want to see is like, many more entrepreneurs getting new things started and, a few ways to bring those things to public markets. What I would say though is like oversaturated is kind of a hard thing to reason about. It every market cycle in crypto, and it is a cyclical industry, although the volatility in each cycle is, I think, mediating that every cycle there's leverage that comes into the system. And I think that's the right way to think about these vehicles. They're a new form of leveraged exposure to the assets. So they're different from the spot ETFs, and that many of them are borrowing against their asset base and going and buying more of the asset. And so there's always demand for leverage in any upmarket cycle where people are optimistic. And that can get like, really out over its skis. So oversaturated, I don't know. It could get a lot crazier.
You don't like my word choice?
Crazier, my point.
I think there's too many. Yeah. Well, yeah. And then I'll think there's way too many. Yeah.
I agree with that as well. And I think the point about leverage is well taken. I think if there's one thing that folks in crypto love to do, it's to find leverage. And this is just another example of that. Putting my lawyer hat on, although I'm not anyone's lawyer who's listening to this other than Jesse, or Variant at least. I think that there's a real question about the regulatory posture of these companies. MicroStrategy, I think, did this quite brilliantly in the sense that they said, we're a software company. That's our purpose. But also we're going to buy Bitcoin because that's how we're going to manage our balance sheet or manage our treasury. What we're seeing in these new companies is basically no attempt to provide any service other than investment management. And if you're going to be an investment manager, then one would argue you should follow the regulations that are designed for investment managers. And the people who are buying these equities are not getting the very specifically designed protections that we as a registered investment advisor have to think all day, every day about complying with. And so I think you could imagine that you combine leverage with, investors who are not receiving the full protections of the securities laws that they might otherwise. And you could imagine one of these things eventually blowing up and it being a real problem for all of us, like it always is when one thing in crypto blows up because one person decided to take on too much risk and expose other people to that risk. So this is frankly something that worries me just a little bit. And I hope that I hope we can keep it under control and that we don't have another blow up of that kind this cycle.
Do you guys buy, this is a really interesting, and I know we need like another hour for this, but the most compelling argument I've heard for it is that it's essentially just a hedge on the dollar and rates, like as a corporate treasury strategy, right? That essentially if you can borrow cheaper, and that's a very bullish take if you're that sold, but like what do you guys think of that just as a concept? I mean, maybe it's true for Bitcoin, but maybe not every asset. I don't know.
I mean, in general, I think I think these assets are hedges on fiat. They're different from traditional equities as well. Like they are non-sovereign stores of value. I think that is true for a number. Bitcoin, I would argue that's true for ETH. I think you could argue that Sol has a non-sovereign store of value premium. And I do think that any a network that is sufficiently decentralized and censorship resistant could benefit from that kind of premium quality of being a non-sovereign store of value. And so that is what makes it a hedge against fiat and equities, in at least in theory. So I think the theory holds up, and over time, I think that theory will prove out to practice.
Yeah, I agree with that. I think it's in a way just a slightly more sophisticated way of saying you should be long crypto, and that's an easy thing for us to say. That said, like, it makes sense to me where you are a company trying to hedge risk against your actual business, and you don't just want to hold cash. And that was sort of how MicroStrategy originally played it. I think it's quite different to say, this is not just a treasury management strategy. We're just an investment fund, skirting the rules that would otherwise require us to go through this very long and arduous ETF approval process, which granted is not ideal. And there, I don't think that the argument holds up very well.
Thank you for indulging us on this topic. This is the most in-depth we've gotten into it in a few episodes, so we appreciate it. Jake, Jesse, thank you so much for joining the show. Before we wrap, we do just like to ask our guests, is there anything else that you guys are watching in DC and beyond? Maybe Jake, the Blockchain Association, what you guys are watching next, that you think others should pay attention to? Obviously, something that we haven't covered already.
I think we sort of nailed all of it.
I was going to say, it might be hard to find something, actually.
Yeah.
Jesse, what about on the founder side?
I mentioned earlier, we're seeing a lot more founders jump into the space. And in particular, seeing a lot of repeat founders coming back. What I'm watching for is to see, a inversion of talent flows, where we saw a lot of folks leave crypto, go into AI. I'm waiting to see, number one, crypto founders who are in the space continue to win and win bigger than anyone thought they would because of, the new compliance pathways that are opening up. And then two, start to see talent flow back into the space because of that, because it's clear you can win in crypto and you can do it in the US. So that's what I'm looking for, over the next couple of years.
Jake, what about this report on the White House report that's due imminently? Do you guys have any thoughts on that?
I do think that'll be very interesting. There's been a lot of engagement, especially with the Treasury Department. So I guess I've come up with at least two things I can throw at you that we didn't get too deep into. One is exactly what you just said, is especially what the Treasury Department is going to say about this key question that we just haven't answered yet in the industry, which is, how do you address illicit financial activity in crypto without just backing your way into KYCing every single user of an on-chain protocol? And I'm hoping that the report will come out quite differently from how the last report that the Treasury Department put out on DeFi came out, which was essentially to say DeFi is useless and this whole thing is for bad guys and we don't like it. I think we're going to see a lot more of a constructive, although still, very, reasonable and fulsome report from the Treasury Department. The other is stablecoins. So, we didn't really talk about the fact that I think everyone is expecting stablecoin legislation to get done and signed into law pretty soon. And, that was a long road, but the Genius Act seems ready to go. And with that signed into law, it's going to open up a huge market for traditional institutions that are excited about using stablecoins, and not just for stablecoins alone, but also just getting more people on chain, right? Getting more wallets in folks' hands and getting more companies to start using, public blockchains in their business in a way that they aren't now. So I think that's going to change things very significantly coming up soon.
Great. Jake, Jesse, thank you so much for the conversation. It's great to have you. We'll have you back.
Thank you. Great to be here.
Yeah,
Thank you
guys.